Hello, this is David at Global MBA Tutorials. Today we're going to go over the weighted average cost of capital, which is also known as WACC, W-A-C-C. So let's go ahead and get started. Okay, our formula for the weighted average cost of capital is, as you can tell, it's uh, right here. I'm not going to read the whole thing, but here we have E equals the market value of the firm's equity. We have D, which is the market value of the firm's debt, which includes bonds that it might issue. V is the value of the company. So V is the value of the company, and that's simply the equity plus the debt. And then RE is the cost of equity. That's the cost that we have to pay in order to maintain the equity. And we have RD, which is the cost of debt. And the cost of debt is how much it costs to maintain the debt. So in terms of debt, it would be paying out interest. So if the company issues bonds, it's going to have to pay interest on those bonds. Cost of equity could be like dividends, if you have to issue out dividends to try to attract investors. So we have a cost of equity, cost of debt. And then we have our TC, which is the corporate tax rate. And that's how much the company has to pay for taxes. So here we have the formula, and we can break it down. This is for the equity side. So we've got the equity divided by the value of the company times the cost of the equity. We're going to add that to the debt over the value of the company times the cost of the debt. And then we're going to multiply that by 1 minus TC. And that's going to be our tax rate. And the tax rate is for the specifically for the debt. All right, now what is weighted average cost of capital? Well, it's a way of looking at a company that you might be, say, interested in investing in, and you want to find out, well, how much is their cost of capital? How much do they have to pay in order to continue their business, to continue operations? And typically, the rule of thumb is that a lower WACC, is typically safer or less risky, less risky. Now, we're not looking at other factors. We're only looking at just the cost of equity and cost of debt. So, for example, if you have company A, let's say you're thinking about buying stock in company A, or you want to buy stock in company B. Company A, let's say they have a total WACC of, we'll say 10%, just to make it easy. And company B has a total WACC of, say, 7%. Well, what is that saying? Well, that means that company B has a lower cost of equity and cost of debt, which means they spend less money on their financing. And because they're spending less money, it's less risky than, say, company A, which is having to spend more money and more money on their cost of equity and cost of debt. Now, so not looking at any other factors, if you were an investor, you might say, well, company B is safer. I'm going to put my money in company B, if you're not looking at anything else. Now, you can have a WACC that might be too low. So for example, let's say we have company C, and company C, let's say they have a WACC of just 3%. It's very low. Now that might say, well, 3%, that's even better. It's even safer company. Well, not always, because if they're not spending money on trying to uh, if they're not trying to do more to invest in the company by increasing their equity or increasing their amount of debt, then they might be missing out on opportunities. So, for example, if the management has a low WACC for their company, the management may not be willing to venture into new markets or may not be willing to spend the money to go into to find ways of improving their products through research and development. In other words, it might be too safe. And so that might be a kind of a bad sign that they're very risk averse. On the other hand, if the WACC happens to be extremely high, so for example, instead of 10%, we have a 20% WACC, that compared to other companies in their industry, then that might suggest that they're spending way too much money on debt and equity, and it might not be a good thing in the long term. All right, well, we're going to go ahead and do the formula. So let's go to the next slide, and we're going to work on a couple of examples. So example 1, it says, investors are considering buying Westlake Company and want to determine its overall WACC. The equity and debt are worth $6.335 billion and $1.721 billion, respectively. The cost of equity and debt are 8.67% and 4.51%. The corporate tax rate is 35%. What is the weighted average cost of capital? So if we use our formula from the previous page, and I'm going to just write the formula here again so that we know what it is. We have WACC equals, and we have the equity over the value times the return, or not the return, but the cost of equity, plus the debt over the value times the cost of the debt, and we're going to multiply that by 1 minus the tax rate, the corporate tax rate. All right, so that's our formula. Now, we know what the E is, we know what the D is, but we don't know what the total value is. So we're going to have to figure out what the value is first. So V, if you recall, is simply E plus D, the equity plus the debt. So we're going to go ahead and add that up. So we have equity is worth $6.335 billion. I'm just going to put a B there for billion. Well, I'll write the whole thing out. Plus, and we have 1.721 billion for the debt. So we simply add these things together. So 6, 5, 10, 6, 7, 8. So our total value for the company is 8.056 billion. All right, now that we have that number, we can go ahead and work on this. So we have our equity, and our equity is, let's see, 6.335. We're going to divide that by 8.056, and we're going to multiply that by the return of equity, which is 8.67. So 0.0867. And then we're going to add all of that to our debt. Let's see, and our debt is 1.721 divided by our total value, which is 0.056 times the cost of debt, which is 4.51%, so 0.0451, and then we're going to multiply that out. Let me put these brackets in. We're going to multiply that by our tax rate, which is 1 minus 0.035. Or, I'm sorry, 0.35. Let's try to make that a 3. All right, let's scribble that out. That is, let's scribble that all out. Let's 0.35. Please excuse the handwriting. All right. So now it's just a matter of putting in the numbers and figuring out what we come up with. All right, so we'll do the first part. And we're going to take 0.6335, or I'm sorry, 6.335, divide that by 8.056, and then multiply that by 0.0867. And we should get, let's see, 0.0682. Okay, that's for our equity. And then we're going to calculate for the debt. So that's 1.721 divided by 8.056 times 0.0451. And that's going to be 0.0096. And then we're going to multiply that by 1 minus 0.035, which is 0.65. Let's see. All right, and then we just take care of those numbers. So 0.0096 times 0.65 plus 0.0682. All right, so that leaves us with a total of 0.0744, and we can convert that into a percentage. So that's going to be 7.44%, and that is our WACC for this company. Okay, now like I said, if you're going to look, what you would do, say if you're an investor and you're wanting to invest in different companies, you would look at the different WACCs for different companies. So this one is Westlake Company. You would find a company that might be similar, in other words, similar in size, maybe in the same industry, manufacturing similar products, and you might compare the WACC and to look at another company and see if that WACC has a higher or lower WACC. And if it has a higher one, well, this one might be considered safer to invest in. Again, we're not looking at any other factors. We're just looking at the cost of capital. All right, let's go ahead and go to our second example, and we can. Okay, for example 2, we have, here's the example. Ryan Industries has a target debt to equity ratio of 0.5. The cost of equity and debt is 10.84% and 9%. The tax rate is 35%. What is the weighted average cost of capital? Well, this one's a little bit trickier than our previous one because it doesn't give us the value of the company or the value of the debt or equity. What it does give us is the debt to equity ratio. And that debt to equity ratio is 0.5. So What does that mean? Well, that means our debt to equity ratio equals 0.5, which, as we know, is 1/2. So what that means is that our debt is going to be 1/3 of the company, while our equity is going to be 2/3. So think of the company, the entire company as being 3, debt is 1/3, equity is 2/3. Okay, so and now we just put that into the formula, and that'll give us what our WACC will be. So we have the equity over the value times the cost of equity, which is RE. We're going to add that to the debt over the value times the cost of debt times 1 minus our tax rate. Okay, so that's our formula. So now we just put in the numbers. Now for the equity value, that's going to be 2/3. So we have 2/3 times our cost of equity, and that's going to be 10.84%. So 0.1084. We're going to add that to our debt over our value, which is going to be 1/3, times our cost of debt, which is 9%. And we're going to multiply that by 1 minus the tax rate. And the tax rate is 35%, so 0.35. So now it's just a matter of doing the calculations. So we're going to take 2/3 and we're going to multiply it by 10.84, and then we're going to add that to 1/3 times 0.09, and then we're going to multiply that by 1 minus 0.35. So at the end, we should get approximately 0.09177. And we can simply convert that to a percentage. That's going to be 9.177%. And that is our weighted average cost of capital. Now, again, like I said, what would you do with this number? Well, you would look at some competitors of Ryan Industries if you're an investor, and you might say, well, let's see, we can compare this to another company. Maybe it's safer, less risky. Maybe it has too much risk compared to other companies, but you would look at this in relationship to similar companies in the industry. All right, that's it for now. Be sure to subscribe if you're interested. There will be future videos. You can also click on like. Also, I'm willing to feel free to send comments or suggestions. I will be looking through them. Have a good day and see you next time.